Maybe we could invite the other speakers up to the panel as well, the ones that are here in person. I believe we have Kingsmill and Victor in person, if they're here. Kingsmill, thank you very much. Victor, please take a seat. Help yourself to some water. Sit anywhere. I think
we sit in order.
Yeah, absolutely.
Thank you.
So we have a great panel for you today to start off with. I'm Paul O'Connor. I look after EMEA ESG debt capital markets for JP Morgan. We are first going to hear from Dr. Anubha Ghosh, who is the CEO of the Council on Energy, Environment and Water, also an advisor to Prime Minister Modi in India. We have Kingsmill, who many of you will know, who's senior principal at RMI, and we have Victor, who is representing the financial sector for Deepening Africa. Welcome all. So before we get started, we are lucky enough to hear from Dr. Anubha Ghosh, and I believe he will be joining us by video. So if we could just cue that segment, please, team, and we'll have a short video, and then we can get into the discussion with Kingsmill and Victor. Thank you. While we're waiting, I also see that Elke has joined from the Net Zero Asset Owners Alliance from Germany. Thank you very much, Elke, for joining us. And if the video is ready, we can maybe get it started. And if the video is not ready, we can go straight into the live discussion.
Understand the human security risks and the economic resilience challenges, we will not understand the third type of risk assessment that I would suggest, which is around the risk of political institutions. It's not just what we are doing to the planet. It is not also just what the planet will do to us. It is most importantly what we will do to each other within and between our countries. And do we have the political institutions in place that can understand and mitigate? Good afternoon, good evening from wherever you are watching this in the world. I am Anubha Ghosh. I'm sending you my greetings from India. I'm sorry I could not join the Climate Bonds Initiative's conference. And I'm sorry for several reasons. One, because CBI is a great partner to the Council on Energy, Environment and Water, which I head. Also because I believe that our missions are very aligned towards transformational change. And I also believe that some of this transformational change is not going to happen unless we sit together and actually get into the nuts and bolts of what needs to be done. Why it needs to be done is very clear. We are going through not one, but 4 crises right now. There is a fuel crisis that developed countries and developing countries are going through. There is a food crisis that many of our economies are going through. There is a finance crisis, not just the availability of finance, but currency depreciation, the challenges we have with multilateral financial institutions, and a lack of cooperation and coordination at a global level. And we have a continuing fever crisis in the form of a pandemic that's not really gone away. What will compound all of these crises is climate change, both as a challenge in and of itself, but also as a challenge and a crisis that exacerbates the other shocks that our economies are going through. But if we have to think about this challenge and think about then the opportunities that arise, we have to first ask ourselves, how do we become a little better prepared for what is coming at us? And I believe the first thing we have to do to make ourselves less vulnerable is to do risk assessments of 3 kinds. The first is the risk assessments around human security. What it means to have a climate extreme weather event impact lives and livelihoods at a community level. But in order to do that, we have to get much more granular in terms of our assessment of risk. We also have to understand risks in terms of our economic resilience. Resilience is not just adapting to a changing climate. It is about how quickly our economies can bounce back from the perfect storms of shocks that we're all facing. What will climate change do to physical infrastructure? What will it do to agricultural productivity? What will it do to trade patterns? What will it do to our livelihoods and sectors that drive the economy into the future? And unless we can understand the human security risks and the economic resilience challenges, we will not understand the third type of risk assessment that I would suggest, which is around the risks of political institutions. It's not just what we are doing to the planet. It is not also just what the planet will do to us. It is most importantly what we will do to each other within and between our countries. And do we have the political institutions in place that can understand and mitigate the shocks that are coming at us in a manner that provides a degree of cohesion and cooperation? But once we have made those risk assessments, I would urge that we all collectively sit down and think about the really hard task of mitigating emissions. If the world has to reach net zero by 2050, if the world has to halve emissions by 2030, we all know we are clearly not there. We are nowhere near on track. But what we have not completely internalized is how do we actually convert that economic opportunity that emerges from the low carbon transition into a basis for international cooperation? It is not enough for us to just talk about the potential. We have to actually look at how we have energy security, resource efficiency, how do we leapfrog rather than just have a slow boom transition, and how we have more interdependence rather than protectionism. Only if we start looking at the nuts and bolts of these issues can we convert the modeled outputs into real outcomes in the real world. And one of those real outcomes in the real world will be the flow of finance. From a country like India, which just in this decade will offer a market of about $550 billion of investment opportunity, whether it's in renewables, electric mobility, or green hydrogen, I have a simple question. Why does not money flow to where the sun shines the most? And I also know the simple answers. Oh, well, it's risky. So what are we doing to mitigate the risks? What are we doing to increase access to not just institutional debt, but to deepen the debt capital markets at home and abroad? What are we doing to crowd in rather than crowd out private investment? What are we doing to reform the institutions that can enable that? Once we think about these stages of first understanding the crises we're currently going through, then internalizing how climate change compounds those shocks, then doing the deep risk assessments at a human level, at an economic level, at a political level, and then see how we can have the collaborations to have deep mitigation while increasing our industrial potential, can we then see where finance comes in? And in what form, with what colors of money? It's these hard, technical, deep conversations that we aren't having enough. So I would urge all of us, our institutions, our leaders, and any initiatives that we might collaborate on, to look beyond the headlines and to get into the bylines. Who is going to author and lead the transition that we all want? It's easy to grab the headlines, much harder to write the bylines. I wish you all a good writing session. Thank you.
Thank you very much, Dr. Ghosh. If you're watching us live or on replay, thank you for sharing your thoughts with us. Clearly, India, a super important player in all of this. So next, I want to turn to Kingsmill, and we were going to talk about one of the key issues here, obviously renewable energy and renewable energy and decarbonizing the energy inputs into the system is fundamentally a building block of achieving this sustainable transition. So I want to ask about the energy trilemma, resolving these issues of energy security, affordability, and also, I guess, generating low-carbon electricity and low-carbon energy generally. How can we navigate this trilemma, as it's called? Maybe you can share a few thoughts with us and give us the latest. Over to you, Kingsmo.
Brilliant, thank you, Paul. I'm going to stand on the lectern. In fact,
Go for it.
I have a little presentation to answer, or seek to answer some of that question. Just while our IT guys are pulling it together, it's hard to speak after the very inspirational Sean and the very brilliant Arunabha, but I shall try. So for my sins, I am actually no green idealist. I'm a kind of hard-nosed city analyst and strategist. I once worked, in fact, at Citibank, and it's nice to see Jane here. And I'm also not here to tell you what you should do to save the planet. I'm here to tell you what you must do to save your profits. I think it's very different. So to answer the very first question of Paul has posed, I guess, the trilemma. The trilemma is solved. The Gordian knot has been cut by Putin. Renewables are now cheaper, so the economics work. Renewables are local, so they provide energy security. And renewables are clean, so they solve the environmental disaster into which fossil fuels have been taking us. So this, therefore, is the decade where I will suggest in this presentation where you will make or lose money. Now is the moment. So if we can pull up my little presentation, if that's all right. So I'm going to start with a very obvious observation, not especially original. Look out the windows. There are no windows, sadly, in this room. But all that sun, all that wind, it's long been the great dream of humanity to exploit it. Every hour, the sun delivers to the surface of the Earth as much energy as we use in a year. The rooftops of our existing buildings alone, so take this building or your own home or warehouses, put solar panels onto them, and they would generate enough electricity to provide all of our needs. In fact, almost twice our needs, without even putting solar panels up onto trusses, precious farmland. But actually, in more prosaic terms, if we take a highly constrained set of areas where you can deploy solar and wind right now, it adds up to 100 times as much as our annual energy requirement. So there's this enormous resource out there. And in the course of the last decade, as Sean mentioned, we have unlocked this enormous resource. We are now able to exploit this almost limitless amount of energy. The cost of solar and wind and batteries has fallen, as you know, by up to 90%. And most importantly, has fallen below the cost of fossil fuel technologies. You then add Putin's war and the doubling and tripling of the costs of fossil fuels, and actually the price points which we were expecting the end of this decade have been moved forward to right now. And this, of course, is not the end. I urge you to read a very interesting paper by Doyne Farmer and colleagues at INET and Oxford University, which shows that once costs start falling on learning curves for granular modular technologies like solar, wind, and batteries and green hydrogen, they don't stop. So costs will continue to fall. By the end of this decade, we'll have extremely cheap solar, wind, green hydrogen, and the prices will enable us to replace the entire fossil fuel system at much lower cost. So humanity, as ever, has responded to the opportunity that low costs bring already. And I almost hesitate to put these charts up because I kind of imagine everyone knows them, but possibly not, because it's worth remembering we have already seen spectacular exponential growth in the deployment of these technologies. I show here solar and wind and electric vehicles and batteries. Look around you. Exponential growth is everywhere, from Vietnam to India to China to Europe to the United States. It's driven by policy and technology, by innovators, by capital. We have an absolutely Cambrian moment of exponential, explosive energy change. This year alone, solar will grow by 25%. Put that a bit in context, the amount of growth of solar this year alone will be about half of the growth of all our all of our electricity demand. Electric vehicles will grow by 60%, green hydrogen by 300% or more. So we have this extraordinary exponential change that's taking place. And what that means, this again is where I kind of put my finance hat on. That growth has just got big enough to start to make a really profound impact on the current system. Solar and wind, in very simple mathematical terms, about 5% of global primary energy supply, according to BP, growing around 20%. That will be large enough to supply all of global energy demand growth up to 1%. So we have just got to the moment where these new technologies are supplying all of the growth. What that means, therefore, we believe that clean energy, so we believe that in 2019, demand for fossil fuels peaked. In 2019, for example, clean energy supplied 85% of the growth in primary energy demand. In the last 2 years, again, contrary to what you may be reading, all of the growth in primary energy demand from 2019 to 2021 has come from clean energy sources. Fossil fuel demand fell over that period. It crashed and it recovered, but it didn't reach its 2019 level. So the peak, in fact, is now behind us. And what that means, therefore, is that the energy future will be very different to the energy past. It means that fossil fuels now reached a plateau. It's going to bounce around for a while, and then it will enter into inexorable and increasingly rapid decline. That means plenty of stranded assets. Those coal fields that you're funding will have no buyers in a decade. Those diesel cars you're financing will have no market in a decade. It doesn't matter how good your ESG score is or how many pictures of solar panels you put onto your annual report. Nobody is going to want your product anymore. All of the growth, all of the opportunity, and all of the innovation is coming from renewable energy technologies. And to conclude, why does this matter? Why does this matter at a bond conference? The reason it matters is because we live, sadly, in a system totally dominated by fossil fuels today, where 80% of energy capital, actually, to be precise, according to Rystad, 84% of energy capital is tied up in fossil fuels, where 50% of syndicated loans are still to fossil fuel extraction and usage companies, where people are mistaking the tactics of greenwashing for the strategic shift from one energy source to another. So, by way of conclusion, the answer now is not just to embrace renewables and shun fossil fuels because it's the right thing to do. It's because it's the only way for businesses to survive and prosper in this new environment. Thank you. I should stop there and hand back to Paul. I think we've got some other questions.
Thank you very much. Thank you very much, Kingsmill. I'm sure there's going to be plenty of questions on that. I believe we will have a bit of time towards the end for questions, so if you do have questions for Kingsmill, please do bear them in mind. I want to turn to Victor. Thank you for joining, first of all. I want to talk a little bit about what's happening in Africa. Clearly, there's an opportunity here to, in a way, skip over some of the, I guess, mistakes that have been made in other economies in terms of locking in carbon-intensive energy infrastructure and the like. Maybe you can give us a few thoughts on how to scale investment in Africa, how to overcome this sort of short-term horizon problem and shift the mindset towards what we might call patient capital. Clearly, a lot of this infrastructure that we're going to need is going to be built out over the long term. You know, we need investment horizons to match up to that. We need to engage a different type of investor, I guess. Maybe you can give us a few thoughts on how you think that investment could be achieved and how we can sort of scale it up and take it forward. So please, Victor.
Thank you, Paul. Thank you, Kingsmill, also for the presentation and to show also the Africa map and the opportunity that is there, especially on green energy. that is wind and solar. I think it's the continent from your presentation that has the highest potential of producing green energy. So yes, there is massive potential in Africa, and I think, as Sean said, we are looking at two things: speed and looking at scale. And the question we want to ask ourselves probably today is, what is the future, and how are we going to be able to make this achievable for the continent, and as the continent of Africa participates in the green bonds and the green energy kind of space. So let me first probably talk about what we have done. FSD Africa and CBI we've been partnering now for about 4 or 5 years in Africa. And the reason why we partnered with the Climate Bond Initiative was to begin a program that promotes issuance of green bond and climate bonds across the continent. And we ran 2 pilot projects with Kenya and Nigeria, just to see, first of all, how that will work. And I think the success behind it has been really good. The public sector has picked it very well. And of course, as you begin such a thing, as you begin such a program, the public sector is bound to pick up much faster. Nigeria alone has issued about 2 billion worth of green debt, and 77% of that comes actually from the public sector. And public sector is simply because of scale. When you think about mitigation and also thinking about how to transition some of the activities that are being issued by these green bonds. We've seen the Nigeria government issue the first green bond that was certified, the first sovereign green bond that was certified by Climate Bond Initiative. I think this was the first certified, CBI certified sovereign bond, green sovereign bond in the world. So that was a really big step forward. And also the project is being reported on an annual basis. We've also seen a lot of participation in the corporate side. We've seen a few first green bonds issued. We've also seen the first green sukuk issued in Nigeria. And the issue of scale also comes into question. And we've had quite a number of other green projects. In Kenya, for example, there was a gap on student housing. This is simply because there's a bulge of middle class in the continent, and half of the African population is now living in cities. So education has really become big, and so you're having a lot of new academic institutions coming up, but student housing was not well provided for. So we thought, why don't we sort this solution out by issuing actually a green student housing bond, which was issued by a company called Acon in Nairobi. Yep. And now it's really scaled up. They've come for the second series green bond. Again, this is all certified by Climate Bond. And the hostels are actually have a 90% occupancy, and they can't be able to satisfy the demand that they're having from different universities. Universities are now offering them free land so that they can put up these green hostels because the hostels provide security and actually more than 50% of the occupants of the hostels have actually been female students, simply because of that security that is being provided with the green hostels and the facilities that are there. So that has also become more of gender inclined and socially sustainable kind of project. Speaking of gender, this year we also promoted and supported the first gender bond in Africa. It was issued in Morocco. And we also have just supported the second gender bond, which was issued in Tanzania. The Tanzania one is particularly very interesting because it was the first sustainable bond that actually had a green arm on it. What do I mean by green arm? It was issued below government interest rate. And so we are seeing private capital now actually placing a non-financial return value on impact bonds, because more than 50% of the people who invested in the gender bond in Tanzania were actually female clients of that bank in Tanzania, which was very, very interesting. And so we are seeing a lot of private capital now placing a premium on impact. And the largest pool of private capital we have across Africa is the pension funds. Nigeria alone sits with about 30 billion worth of pension funds. But this money lacks diversification options. So you find most of the funds are invested in sovereign securities or government securities. In Nigeria, for example, 80%. In Kenya, same thing, 80%. So we are seeing an average of about 70% of the funds across the continent, the pension funds, are being invested in government bonds. And so some of these funds need options. They need new products to come in, and especially impact-focused products that will help facilitate them to invest in these particular securities. What is the future? We are coming up with very innovative ways to encourage the private patient capital that is ready to sit on the long-term end. As you know, commercial bank money is really not patient capital. But when you think about the pension funds, when you think about some of this private capital, it's quite patient and can come and promote a lot of the climate bonds, because you're talking about long-term bonds being issued that can actually be invested in. And so we're coming up with new strategies. Some of them is to de-risk some of these bonds. We are de-risking them how? As a first loss investor, as FSD Africa, we are putting in our own money to just help us create a first loss kind of mechanism or mezzanine investment. We are also issuing credit guarantees with some of our partners, like InfraCredit, who we've partnered with, and are now wrapping the bond to reduce the risk on that. And of course, there are other risks that we are coming up with clever ways of dealing with, like currency risks. And, but there are also other creative ways that could be helped to promote the bonds in Africa. And we're already thinking about some of these ways in the future. For example, the flower farms, the flowers that you buy in London could easily have come from Lake Naivasha, which exports a lot of flowers of Kenya to London. And if Marks and Spencer, pick for example, could actually issue an ESG bond based on the supply green chain that they have created on the flower farm, and list the green bond on the London Stock Exchange based on its supplier risk and how they have actually created a green chain of that supplier risk. The flower farms themselves, since their revenues, 90% of their revenues is in hard currency, it's in US dollar, could actually issue an impact bond based on that same factor of how they have greened themselves. Speaking about security, and when I started, I poured myself a glass of water, because this commodity alone in the continent of Africa supports 1.4 billion people. And this is because when you think about agriculture, when you think about security, when you think about sustainability, you cannot separate it from water. Mm-hmm. Benue, which is a big river way that touches about 4 countries in West Africa, gets flooded, and different countries struggle with the flooding. How do we issue climate bonds that are helping tap this water and generate electricity with it, irrigate farms with it, create sustainable agriculture out of it, and also at the same time give access to clean water using the same dams? So you're creating both a social security issue, because once these people are evicted and the place floods, they invade their neighboring community, and that becomes an unrest. The drying out of Lake Chad. Lake Chad, as many of you know, I think the waters have what it was about 50 years ago. It's lost almost 70% of the water that has been there. And this has created a massive security issue for all the 4 countries that surround Lake Chad. And so we are seeing a lot of tying in of all these issues of climate with security issues across the continent. And therefore, it has become very important for Africa as we sit right now to issue a lot of climate bonds to help this. They might be agriculture bonds. We are already speaking with the governments on issuing agriculture bonds to support supply of water, recycling of water, and all that. As you've seen, the green building that are being done, the student buildings in Nairobi, we have quite a number of them coming up now being built by Aecon. One of the biggest aspects of this green building is water, making sure the students have clean water and the water is recycled and all that, so it's very key. So these are actual projects that we put in ground, and I think there's a huge potential, even for the companies across the globe, that, for example, as I've given an example, it's, if you're being supplied for products from the continent, it's actually possible for you to issue an ESG bond based on your supplier risk and how you're actually facilitating greening that chain. Yeah.
Thank you very much. Some great ideas in there, and it's great to hear of all this work going on. I mean, I'm particularly interested in the point you raise about supply chains. I mean, increasingly, we are talking to people who operate what you might call a dematerialized business model. They are a brand, they sit on top of a very long value chain. Often the value chain or the supply chain starts in places like Africa. And the question is, how do we present that story, and understanding that supply chain with all the intermediation in it and looking at de-risking it and how you communicate that story. I think we're going to see more bonds built on that sort of thing in the future. So I think these are great examples and really thought-provoking, so thank you for that. I want to turn to Elke now to talk a little bit about the investor viewpoint. Thanks, Elke, for joining us from Germany. I guess, broad question, if you can give us some thoughts on the investor perspective. Why should investors pay attention to all of these things? Now, clearly, time horizons are also relevant here, and clearly, as time goes by, we see more of these risks, which at the moment are theoretical, starting to emerge. But maybe you can talk a little bit about the investor perspective on long-term risks like climate change. How are investors thinking about this? Looking at your work through the Net Zero Asset Owners Alliance, and maybe commenting a little bit on how the investor members are thinking. So over to you to give us some perspectives on how you are looking at investment risks right now relating to climate change. Thank you.
Thank you very much, and thank you for having me. So I may ask, I hear an echo.
It's clear on our side,
Elke.
Elke.
As well? Thanks.
It's
so you hear me well, right?
Yeah, it's all good.
Yeah, wonderful. Thanks. Thanks for having me for this great conference and panel. And yeah, indeed, somebody asked, why should investors pay attention to climate-related risk, and why do asset owners decarbonize investment portfolios by 2050 alongside science-based decarbonization pathways? Long-term investors are aware climate risk is long-term the highest economic risk. So not acting will come with higher costs and risks, physical risks and risks of stranded assets than acting. And prosperity and a healthy economic development will only exist based on functioning ecosystems. Our planet and nature is the basis of living and of our economy. So we are currently facing increasing billion-dollar events, ongoing weather extremes with loss of lives, huge negative environmental impacts, and impacts on harvests in all parts of the world. We see droughts, wildfires, floods. So shareholders and long-term investors, like members of the Net Zero Asset Owner Alliance, insurance companies, pension funds, but also sovereign wealth funds and endowments are aware long-term sustainable strategies are decisive to secure against the downside risks, but most importantly, to create growth opportunities. So sustainability is profitability. And science tells us that this decade is critical for action. It seems this is our last chance to transform. We are on a good path. We are hearing, it's very encouraging, so the presentations I've heard before, but we must not lack ambition. Let's be bluntly and crisp, change, or we will be forced to change. Indeed, the future it must be green. And as the future, as we further, as we might overshoot 1.5, the greater the extent to which we will be forced to adapt with higher costs, permanent loss of nature, biodiversity of human lives, but also social turmoil. And as 80 to 90% of the global emissions are currently already covered by a net zero goal, it is inevitable that as countries turn national commitments into credible policies, every sector will and must be transformed with huge investment opportunities in a new green economy. And therefore, I mean, investment needs and opportunities are estimated 3 to 6 trillion US$ annually. And these are perhaps the biggest opportunity for decades.
Thank you very much. And so from what you're saying, clearly there's issues to address. Sorry.
What are the difficulties? Why don't we see this capital moving, as King's just asked in his presentation? So what are the difficulties? I mean, most of the capital is nervous, is shy, let's say, especially when it wants to be invested long-term, and especially for investments in new technologies and innovation, as the future is uncertain. So there is this huge elephant in the room. I mean, we heard it today several times. It's the risks. And there is a diverse set of risks. It's political risks, currency risks, regulatory, operational, project risks, and many other. And then there is a second large obstacle, which is intransparency, which fuels the perceived risk.
Thank you. I'm not sure if you can hear me, but I was just going to ask, in terms of solutions to some of these issues that you've raised, I mean, in terms of your work with the asset owners as part of the NZAOA, what would you say some of the most attractive solutions are to overcoming some of these challenges?
Yeah, thanks for this question. This is even most important and most critical. Please, I hear again the echo. If you could close the, thank you. Yeah, I would say there are like three main thematic blocks, which I would see as crucial for the solution. First, we need stable and reliable policies. These need to be in place, providing the ground for long-term investments, supporting demand and supply of sustainable deployment. And these includes reliable governance planning, like detailing NDCs to sector pathways, long-term development of project plannings, incentive models favoring sustainable deployment, like carbon pricing, respective subsidies, tax reliefs, giving some examples, respective sector regulation, sector per sector, and then very important and crucial, mandatory companies' disclosure of transition plans. That's regularly quality assured information which can be fully integrated into decision-making processes so that the markets operate interconnected and efficiently. The second block, all financial institutions, all investors, asset owners, asset managers, but also banks need data. Data, reliable and standardized data for transparency and for enabling risk assessment, as known risks reduce the risk perception. Therefore, a very important second block to reduce the risk is transparency and data. So disclosure of climate performance of companies, let's say carbon footprinting, but more importantly, transition plans, investor need for forward-looking assessment. Therefore, we need platforms and tools to support this transparency. So publicly available data pools with standardized climate data. And then sector pathways for countries and regions, I explained before, which can be used as a benchmark for industries to assess, is this respective company in line with a decarbonization pathway, in line with 1.5? And then net zero aligned benchmarks, a very important tool for all asset classes, not only for listed equity. And therefore also, of course, every single constituent needs to disclose carbon performance, listed assets, projects, real estate, but also green transition and sustainability linked bonds. This then allows financial institutions for carbon footprinting, and more importantly for investment portfolio alignment to net zero. And the third block we discussed also earlier, especially Sean in his speech, we need financial structuring which helps addressing the risk. Structures like fund structures that pool and diversify risks, including hedging solutions, blended structures, private-public partnerships, guarantees, especially blended finance we see as a win-win situation. While the private sector benefits from improved risk profile, the public sector achieves a multiplier effect. And then for sure, the bond market, green bonds, transition bonds, sustainability-linked bonds, this is crucial. So these are the three main blocks: policies, data and transparency, and financial engineering, let's say. And last, very last on a fourth one, we need ambitious leaders and collaboration across all stakeholder groups. Thank you, Paul. Back to you.
Thank you. Thank you very much, Elke. And really finishing on a very important point there. I mean, I think from my perspective, I see some corporates are going as fast as they can. I think there is a need for government to step in and recognize that there are limits to what private capital can do on its own, and sort of preparing that ground for increasing investment in certain technologies and jurisdictions. I think that's going to be very important in the years ahead. I think we'll have a bit of time for questions, so please put your hand up if you have a question. But in the meantime, I just wanted to pick up on one thing with Kingsmill, if I can. So, given that gas clearly is challenged now as a source, a reliable source of energy in Europe anyway, given the current situation geopolitically, other forms of energy generation technology obviously can step forward into the vacuum, and there may be more competition for capital available. Would you say this is a problem for renewables in terms of building out the renewable pipeline? And are we going as fast as we can on renewables, or would it be possible to go faster? Do you see this competition for capital as a barrier for the growth of wind and solar and sort of dark green renewable technologies? Or do you see that there is opportunity for increasing the pace of investment in renewables?
I mean, of course, the answer to your question is it depends where you are in the world. I mean, as I'm sure Victor would say, there are certain countries which struggle to get the capital to deploy the renewables that they want. So it's not a simple answer. But in broad terms, to answer your question, if you talk to developers, who are actually the people putting into place all of these technologies, they all say we lack projects, not capital. And what they mean by that is they lack good policy and regulatory environments in which they can deploy this superior technology. And there's fabulous work done by Bloomberg New Energy Finance. They release annually their Climate Scope report. And this Climate Scope report charts policy against capital. And it's extremely clear. You put into place the right policies, you will get the capital. Now, that observation applies, I think, probably to about 80% of the world. There is a further subset of countries which the World Bank calls fragile states, where the situation is much deeper and more problematic than the electricity system. And clearly you need much deeper answers for some of those countries. Part of the answer, for example, is for the World Bank to go in and help to de-risk the deployment of these new technologies, to find ways to reduce, as Victor said, the disparity between taking foreign currency risk and actually having local currency revenues. And there are clearly problems to be solved. But to answer the very final point, in spite of all of this stuff, in spite of the difficulties, renewables keep on getting deployed. And this is what's been very interesting and notable over the last decade, is that all of the forecasters, particularly all of the fossil fuel forecasters, such as the old IEA or Exxon or OPEC or whatever, they've all been completely flat wrong about the exponential growth of these new energy technologies. So, for example, this year, here we have the war and the disaster and everything else, and solar, according to BNEF, we will deploy 250 gigawatts this year. 10 years ago, we were deploying 20. It's quite extraordinary. The Chinese solar panel industry is putting into place enough capacity to produce 1,000 gigawatts of solar by the end of this decade. And that actually will be quite sufficient in and of itself to create a revolution. Anyway, all I'm really saying is it's not easy at all, and there are certain countries where it's extremely difficult, but on a global level, it's feasible. But what we need to do, policymakers need to step up to the plate, stop fiddling around with all of their kind of feeble attempts and revanchism to do fracking in the UK or whatever, and just put into place proper policies to build out solar and wind. I mean, can you imagine it still takes 10 years? We're in a crisis in Europe, and it's still taking 10 years to put solar and wind into the ground. I mean, it's ridiculous. So yeah, it's policy, primarily policy in most places.
Thank you. Thank you very much. I wanted to just give people a chance to ask Kingsmill any questions while we have him here. Is there any questions that people want to... So two at the front here.
Nick Robbins from London School of Economics. Great comments from Malcolm and Victor and Kingsmill. I think we've seen the extraordinary opportunity on the supply side on renewables. To use an old-fashioned fossil fuel phrase, it seems that this could be turbocharged on the demand side if we really get serious about energy, resource, and water efficiency. So I think you've painted a very disruptive and positive picture, Kingsmill. But could it be more disruptive if we get very serious on the energy, water, resource efficiency? And also to Victor and Elke as well. Thank you.
I don't know if you'd like to.
Yes, I mean, I can respond, sorry. I think as far as the continent of Africa is concerned, the opportunity is massive in terms of speaking about renewables and what potential is there for the continent. And probably it's more, the answer at this point is more on a structuring solution. How do we structure this? So let me give an example of a program that we've just kicked off on the renewables. So we've set up together with our partner InfraCredit in Nigeria, we've set up an SPV, a special purpose vehicle, and this is mainly focused on mini grids. And this is just to help small little enterprises and corporates that want to set up mini grids. As you know, the distribution network in Nigeria is very, very poor. So mini grids work very well because those particular mini grids can supply the immediate community. If it's a community of 3,000, 5,000, 10,000 people, the mini grid can focus on them and supply the energy to them. Most of these mini grids are solar mini grids. This is PV. And we already actually have a pipeline of about 5 companies that have gone through the credit analysis and everything, and they're looking for construction loan. And so this will be green bonds that will be issued in the next couple of weeks to support these mini grids and the setup of these particular mini grids. The impact of such an investment by the investors will be actually tracked on real time, and you can actually know how many families are touched and how the families and their lives have been changed. So there's both a social aspect, of course, and an energy need. There's a huge energy gap across Africa, many people without electricity, and yet we have renewable energy that has not been tapped into completely. So yes, there's a great opportunity. There are things that are being put in place. Other African countries have quite a stable distribution network. For example, Nairobi and Kenya have a very good distribution network. Turkana has one of the largest windmills in the world, was set up in Turkana in the north. And this is actually able to supply quite a significant amount of electricity across the country. And so we are seeing a lot of foreign direct investments coming in, bonds that are being issued by even some of these energy companies in their countries, and they're coming actually to set up these energy companies in Africa to supply energy. So yes, it is actually possible, and it is already happening.
Thank you. Another question there at the front. Go ahead.
I'm not sure. Yeah.
That's on.
Hi, thank you. So I'm going to be a little bit pessimistic and just see if I can throw cold water on here. Maybe you can make me optimistic again. But I noticed kind of on the charts that you were showing, there was extremely quick reductions in the cost of a lot of the technologies you're talking about. But then at the very end in 2020, 2021, you actually see that stop. And we've seen that in 2021 and 2022, the costs have actually gone up for the first time ever. And then with a lot of these projects, it's very capital intensive up front. So the cost of capital is very important. But of course, for most of the period that you were looking at, interest rates were basically zero, and now they're not zero anymore, and they're especially high in emerging markets. And then kind of turning to emerging markets where a lot of this investment's needed, their budgets are stretched. You know, we're looking at some countries that are really in trouble right now. And when you look at kind of the overseas development aid that we need to provide that de-risking you were talking about, we're seeing a lot of countries cut back on that or refunnel the aid that was supposed to be going to development to help in the Ukraine efforts and things like this. So kind of not really a question, but cold water on the discussion. Just wanted to see what your thoughts are, if that affects your outlook going forward and what can be done about it.
Go ahead, Kingsman.
Sure, brilliant. If I'm just very quickly, I'll reply to this, just comment on Nick's observation about more disruption to come. Don't forget, we've only just got lower prices in two areas of electricity, sort of wind across the barrier and light transportation where EVs have kind of reached the barrier. It's coming in lots of other areas as well. So briefly to answer your question, Nick, I think we've got to see a lot more disruption to come, and we even need to recognise the disruption that's coming from what we've already done. Anyway, coming out onto I smiled when I heard this question about falling prices, because maybe we've had falling prices for renewable technologies for 30 years and now it's over. And that's certainly what the fossil fuel industry would love you to think. Look, who can predict the future with absolute certainty? But that framing is highly unlikely to be accurate, and I'll explain why. So again, I go back to this work done by Doyle Farmer at Oxford. They looked at a series of technologies over, I think, about 180 technologies over 200 years, or wherever they can get data. And what they found is that once your costs start falling, once you get onto learning curves of deployment, they are extremely sticky. That is to say, they carry on going. So you can often have periods of a couple of years where costs stop falling, but then they keep on going because some bright spark in Kenya or Mongolia has a better way of doing something, and that idea then gets rolled out across the world. That's what happens in modular technologies with huge amounts of growth. So I think to answer your first point, have costs stopped falling? Highly unlikely. And actually the other observation is, don't forget that the innovators where costs are much lower, like India, their lower cost structures can be copied by other countries which are higher and which are later to the party, like Vietnam, for example. So that's what I said about costs. On this other point about cost of capital, again, as a finance guy, just look at the Lazard LCOE calculations. They show you the cost of the cost of solar and wind and coal and gas at different costs of capital. I think it's LCOE version 13.0. Lazard just does it every 6 months. Anyway, their cost of solar at 4% cost of capital is about $42 for the United States. And at 10% cost of capital, it's 52, right? So it does indeed go up. But as you can see, not by that much. And furthermore, the cost of the competing technology of gas or coal, again, they did this analysis before, the very high gas prices, but gas starts at 55 and goes up to about 65. So sure, it's going to be higher cost, but not dramatically higher, and no higher than the current fossil fuel alternative. So it doesn't, because humanity ultimately needs energy. It's not really going to stop the transition from happening. High cost of capital, and then the final point about emerging markets have no money. All change is sequenced, and if you look, for example, at the rollout of the internet, or the rollout of mobile phones, you see a very clear pattern. It happens first in richer developed countries, and then as costs come down, other countries deploy these technologies. So I think we are having a fairly similar situation here. Richer, wealthier countries are deploying deploying the technology fastest. They, of course, are the largest. The OECD plus China is still 75% of the total demand for energy globally. And the chain, they're not held back by a lack of capital. So I think, you've got to be very, very precise about which countries and are they big enough to move the needle. And then, the very final point I would make is that there are certain countries or regions at the moment which are undoubtedly struggling to deploy these technologies. But they, in 2022, are very small compared to the total. But in 2030, they will be relatively large. But by 2030, the costs will be dramatically lower. So you actually have a solution there as well. So I think all your points are valid, but they're also all soluble.
Thank you very much, Kingsmill. Go ahead, one more question I think we have time for. Maybe we take gentleman at the front, seeing as you have the mic. Go ahead.
Aaron Kelschker, University of Cambridge's Centre for Resilience and Sustainable Development. So my thanks to the panel for sharing some great insights. Maybe just picking up a couple of points of, Victor mentioned pensions. I know obviously on the asset owner side there's a very large conversation. We've seen TCFD implementation, become mandatory on the company side. Here in the UK, I think was the first country to codify it. And so overnight, 1,300 companies are now reporting against TCFD. And here in the UK, we've also seen the Pension Schemes Act 2021 make mandatory TCFD reporting for pension schemes here to try and, I guess, accelerate the decarbonisation of pension portfolios. Given that the pensions industry globally is probably around 56 trillion, how can we actually accelerate that movement of capital, and especially towards the greening of pensions? I'd welcome the insights of the panel. Thanks.
Any thoughts on that? Maybe Elke, I don't know if you caught that. It was about moving the pension pot. Maybe you have a few thoughts on that. Thank you.
Yeah, thank you very much. I mean, basically, just repeating what I've told. We need these regulations also in other jurisdictions, clearly. And then we will see capital flow. I'm quite convinced, as we said before, policies are key. On the other side, the factor is that investors will ask more and more for this kind of transparency, pushing for these policies, and also pushing, the real economy for this kind of transparency. So therefore, we will see, and I'm quite sure, acceleration of data, of disclosure, and also getting to a next level, which needs to be standardization of data, also Scope 3 reporting, and then development of tools which are needed. And if we all work together, like with the service providers, consultants, with the real economy, with policies, there will be a huge acceleration, I'm quite sure, in the data transparency and disclosure, which needs to happen. So this is basically answering, just repeating what I've said before. So we need to come to a next level now, and this is what I already see moving.
Thank you. Thank you so much. I think we have time for one more. I was given a little bit of leeway, but I don't want to go on too long because you're probably eager for a break. But maybe just one more question then.
Paul, probably.
Sorry, go ahead.
I can just add to what
Sure.
Alan asked about the private capital, and especially for the pension funds. And regulation is very important. In fact, it's one of the starting points when we get into any market as FSD Africa. When we start having discussions with any capital markets players, the first thing actually we do is have discussions with regulation. But every time you talk about regulation, you have to use the word appropriate regulation, so that you just don't put a regulation on market players for the sake of putting it, but it's a regulation that is appropriate for those particular market players. And when you start speaking about that kind of regulation and asking the pension funds themselves to report on how much of their portfolio is green, is also to ask yourself, how many products are there that are green that these actually funds can invest in? And it also depends on the size of the fund. If you're talking to a huge fund, Vanguard, BlackRock, the one ticket size is so massive, can they get options to invest in such a ticket size? And so that's also very important to ask yourself, is the regulation appropriate? Are there products that are there? So in Africa, for example, we've seen a lot of regulation change. Generally, fund managers are allowed to invest, and pension funds are allowed to invest 20 to 30% in, say, private capital, but less than 1% is invested in private capital. When we do an analysis of banks, just analyzing their portfolio, we actually discovered most of the banks, 20% of their portfolio is already green, even before the bank taking a green strategy. You'll find that many of the loans issued out, the assets that they're holding, some of them actually have been invested in green. So again, if you're talking to a central bank and asking a central bank, could you adopt the TCFD regulations? So for us, we found it actually easy as FSD Africa to have conversations with central banks, because we've analyzed the bank's portfolio and we've discovered most of the banks have a green portfolio inside them. They actually didn't know that some banks actually is as high as 35%. And so you can now ask the central bank to implement such a reporting, because these guys actually already hold green portfolios, only that they don't know about it. So that's an appropriate regulation that will bring out the status in that particular market. So appropriate regulations, yes.
Thank you. I promised one more, so this is the last one, but thank you for waiting. Please go ahead.
Thank you. So one more question, and perhaps challenging the notion that financial engineering will fix these challenges that have been outlined. Kingsville outlined that, in fact, the areas of greatest abundance, excess abundance of renewable energy are economies that have relatively contained demand for energy, which suggests, in fact, that our efforts to transition may be limited by the economic structure of the economies where renewable energy is most abundant. So isn't what we really need for green transition then green electron superhighways, which can transport the renewable energy produced in these countries to the developed economies which really are reliant on mass energy? Don't we need some out-of-the-box thinkings which tap into international trade and finance, rather than just looking at how to build renewable energy in developing economies for their own use? Thank you.
Yeah, it's interesting, the source of the energy not always in the place where demand is highest, and how do we move it around? We have seen, I think, some of these projects coming. I believe there's one in Morocco, but maybe Kingsmill, you have a few comments to add on that one?
Yeah, sure. I totally agree with you. We need green electron superhighways, because I mean, as that map showed, there are certain regions and countries which are a little bit constrained in terms of space. To be clear, it's actually 10% of the world only, and it's Korea, Japan, and the Netherlands and Belgium and Germany, and a few other places. There's a relatively small number of countries, but they are indeed constrained, and so I mean, everyone's trying to figure this one out right now, and as you mentioned, we have the X-links, Morocco to the UK, which seems like a very good idea, and you have the plans, in Australia to take green hydrogen either out through ammonia or through the cable to Singapore. I actually think that one of the most exciting new technologies right now, and certainly something worth backing in this country, is the cable manufacturers who are actually manufacturing this cable. They're really clever cables to get these technologies. And now happening in the North Sea as well, actually, with the energy islands that Denmark is building, which are enabling you people to provide energy. So yeah, it's really exciting. We don't quite know the answer yet, but as so often in the energy transition, you've just got to try and see what you can do, and the market will figure it out.
Great. So really optimistic note to end on. I think we'll have to leave it there. Thanks everyone for your attention. Thanks everyone online for listening. And if we could just show our appreciation for the panel, that would be great.
Thank you.
I'll hand it back to Sean.